Why I chose SCHG over VOO or QQQ comes down to a decision most investors wrestle with. Do you want the steady reliability of the S&P 500 or the high growth excitement of the NASDAQ 100? And after years of trial and error, I didn't go with either. I chose SCHG as my growth play, while still holding SPLG as my core S&P 500 fund. Now in this video, I'm going to break down exactly why that mix makes sense for me. Now for me, it wasn't about chasing hype or trying to time the market. It came down to three things: growth, cost, and diversification. SCHG gives me exposure to the fastest growing companies in the US at rock bottom expense ratios, while SPLG anchors my portfolio with stability. And that's why SCHG beat out both VOO and QQQ for the growth side of my portfolio. Today, I'll show you how these three ETFs stack up and how you can figure out which combination might make the most sense for your long-term goals. Hi, I'm Greg Hardy and welcome back to the channel, and thanks for being here. We cover all things personal finance, investing, and building a secure financial future on this channel. So if you're serious about taking control of your money and learning something new every week, make sure to subscribe to the channel and like this video. It really helps this channel out and gets this information out to more people who need it. Thank you. When most people think about index fund investing, the first name that usually comes up is VOO, the Vanguard S&P 500 ETF. It's one of the most popular funds in the world because it tracks the 500 largest companies in the US, giving you broad diversification in a single fund. Now, you're essentially buying a slice of the entire US economy, anything from tech to healthcare to energy and consumer goods. With a rock bottom expense ratio of just 0.03%, VOO is cheap, reliable, and built for the long haul. That's why so many investors use it as their one-stop shop for long-term wealth building. On the other hand, you've got QQQ, which tracks the NASDAQ 100. This fund is all about growth and innovation. It's packed with big names like Apple, Microsoft, NVIDIA, Amazon, and other giants that dominate the tech-heavy landscape. Because of that, QQQ has delivered some massive returns over the past decade, but it comes with higher volatility as well. It's more concentrated, with tech making up a majority of the portfolio, and while that can be great in bull markets, it can also mean sharper drops when tech goes through a rough patch. QQQ's expense ratio is 0.2%, which is still reasonable, but much higher compared to broad market funds like the VOO. Then there's SCHG, which is Schwab's US Large Cap Growth ETF. This is the one I ultimately chose for my growth exposure. SCHG focuses on large cap companies with strong earnings growth and future potential, similar to that of QQQ, but it spreads that exposure across multiple sectors. You still get plenty of tech, names like Apple, Microsoft, and NVIDIA, but you also get growth leaders in healthcare, consumer services, and other industries. And here's the kicker: the expense ratio is just 0.04%. That means for every $10,000 invested, you're only paying about $4 a year in fees, which is significantly lower than QQQ. If we line them up side by side, the differences become clear. VOO gives you broad diversification and stability at the lowest possible cost, but it's not growth tilted. QQQ gives you explosive growth potential, but with higher volatility and fees. SCHG sits somewhere in the middle, still growth focused, but more balanced across industries, and with ultra low fees, that lets you keep more of your returns. That's the trade-off every investor has to weigh: safety and stability with VOO, pure growth with QQQ, or a growth-focused but cost-efficient option like SCHG. Now let me be clear, I have nothing against VOO. In fact, it's one of the strongest long-term investments that you can make. It's diversified, low cost, and historically very reliable. Right now, VOO trades for a little over $600 a share, and it comes with one of the lowest expense ratios in the ETF world at just 0.03%. The problem for me is that VOO is just too expensive and broad for what I wanted. It owns everything from high-growth tech companies all the way down to slow-moving utilities and traditional businesses. That's not bad, but it means the growth side of the portfolio gets diluted by companies that don't move the needle as much. What I really wanted was more exposure to innovation-driven companies, the ones leading in tech, healthcare, and other fast-growing industries. VOO gives me stability, but it doesn't lean heavily into growth. For my goals, I needed a fund that could capture more of those long-term trends without losing the discipline of diversification. That's why I still hold SPLG as my S&P 500 core, but for my growth engine, I didn't want to rely on VOO alone. So while I respect VOO as a core building block, and for many investors, it's all they'll ever need, it didn't check all the boxes for me. I wanted something that could give me stability in one piece of my portfolio and stronger growth potential potential in another. That's the gap SCHG fills, and it's why I chose to complement SPLG with it instead of sticking with VOO by itself. Now let's talk about QQQ. This is one of the most popular ETFs out there, and for good reason. It holds some of the biggest winners of the last decade. But here's the catch. QQQ is very concentrated. Top 10 holdings make up more than 50% of the entire fund, which means your portfolio is really tied to just a handful of companies. And while that could look amazing in a bull market, it also means heavier swings when things turn the other way. And right now, QQQ is pretty pricey as it trades for around $600 a share. And another factor is cost. QQQ's expense ratio sits at 0.2%, which is quite a bit higher than SCHG's 0.04%. That might not sound like much, but over decades of investing, those costs really add up. SCHG gives me very similar growth exposure, but with a fraction of the ongoing fees. For me, that's a big deal because it means more of my money stays invested in compounding instead of going to fund expenses. SCHG gives me balanced growth exposure across multiple sectors, not just tech, and that's one of the biggest winning features of my portfolio. Even though it has many of the same high growth names like Apple, Microsoft, and Nvidia that you'll find in QQQ, SCHG spreads its bets more broadly across healthcare, consumer services, and other non-tech growth areas. That makes it feel less like I'm riding just one wave and more like I'm surfing multiple ones. Also, SCHG is trading at around $32 per share as of right now. Now, I know I've mentioned this before, but the cost side is huge too. SCHG with its expense ratio of 0.04%, which is unbelievably low for a growth-oriented fund, and with those low fees, more of your returns are going to stay invested in the fund and compound over time instead of just being eaten away by expenses. So when I compare that to the 0.2% or so for the cost of QQQ, the gap becomes meaningful over a multiple decade horizon. Another win for me is how SCHG has performed over the long term. Over the past 5 years, SCHG has posted a total return of about 135%, which works out to a compound annual growth rate somewhere in the high teens to low 20% per year. When you compare that to VOO and QQQ, you'll see that while QQQ may have had higher peaks in certain years, SCHG's growth plus lower drag from fees gives it a better risk-adjusted profile. For example, VOO has annualized returns of around 14 to 16% over the last 5 years, while QQQ is higher, but it does come with more volatility. Finally, SCHG fits cleanly into my 3-fund strategy as its growth engine. It gives me upside when growth trends run hot, while still being diversified enough that I don't lose sleep at night. And by pairing it with SPLG as my S&P 500 core position, and SMH as my semiconductor conviction play, I get the growth that I want without being overexposed to a single sector or stuck with extreme volatility. For those of you that are new to investing, when you build a portfolio, it helps to give each fund a clear role. For me, SPLG is the anchor. It's my steady S&P 500 core that covers the broad U.S. economy. SCHG is the growth driver, giving me exposure to innovative companies across different sectors. And then SMH is my conviction play. It's focused on semiconductors, which I believe will have a big long-term potential. And by keeping each fund in its own lane, core, growth, and conviction, I stay disciplined and avoid chasing short-term market swings. The goal here isn't trying to chase quick wins or time the next big tech boom. It's about building a portfolio that I can live with for decades. One that grows steadily over time while keeping fees low and exposure balanced. SCHG gives me the growth potential that I want without adding unnecessary risk, while SPLG and SMH provide the foundation and targeted upside that round out my strategy. Of course, this isn't the only way to invest. Some people might prefer VOO for a simpler, ultra-stable approach, or QQQ if they want a heavier tech exposure and can handle some volatility. The key takeaway is that your portfolio should match your goals, risk tolerance, and long-term plan, just like SCHG fits perfectly into mine. Investing isn't just about picking the best fund. It's about creating a system that you can stick with over the long term. Choosing SCHG over VOO or QQQ wasn't a snap decision. It was about finding a balance between growth potential, cost efficiency, and diversification that fits my goals and risk tolerance. So when your portfolio aligns with your strategy and your lifestyle, it's easier to stay disciplined during market ups and downs. And that consistency is what ultimately drives results over decades. The beauty of this approach is that it shows there's no one-size-fits-all answer in investing. Some investors are going to thrive with the stability of VOO, others with the high-octane growth of QQQ. SCHG just happens to fit my 3-fund system as the growth engine while keeping my exposure balanced and my cost minimal. The real takeaway is this. Focus on building a portfolio that works for you. Stick to it and let time, not emotion, do the heavy lifting. If you found this video eye-opening, don't keep it to yourself. Share it with someone who you think needs to hear it. And if you want more practical, no-nonsense advice on building wealth and securing your financial future, then check out this video right here. And also, please make sure to subscribe. Thank you for watching. I'll see you in the next one.